I am going to walk you through something that most personal finance videos never do. Not a hypothetical, not a warning about what could happen. An actual month-by-month timeline of what does happen, specifically and predictably, when someone buys a house they can barely afford. Not a house they absolutely cannot afford. Not someone who was reckless or financially irresponsible. Someone who was pre-approved. Someone who ran the numbers on paper and it worked. Someone who wanted to stop renting and start building equity and made the decision that felt like the responsible adult move. And I want you to watch this timeline unfold, month by month, because there is a specific moment, somewhere between month 4 and month 14, depending on the person, where the decision that felt like progress starts to feel like a trap. And by the time most people recognize that moment for what it is, they are already too deep inside it to get out cleanly. More than 60% of homebuyers spend more than they expected on homeownership, according to a 2026 credible survey of over 1,000 homeowners. More than 20 million American households are currently classified as cost-burdened, spending more than 30% of their income on housing. 64% of homeowners say homeownership costs have caused them financial stress. These are not people who made obviously bad decisions. These are people who bought houses they could barely afford, and then watched the timeline I am about to show you play out in their own lives. This is that timeline. My name is Sig, and I spend way too much time thinking about money, the specific sequence of events that follow certain financial decisions, and the gap between how a decision looks on the day you make it and how it looks 18 months later when you are living inside the consequences. If you are considering buying a home right now and you want to understand exactly what the next 2 years look like if you buy at the edge of your budget rather than comfortably within it, subscribe to this channel right now and give this video a thumbs up if it gives you something no mortgage broker ever will. The honest timeline of what actually happens next. Jason is 34 years old. He earns $85,000 a year. His take-home after taxes, his 6% 401k contribution, and his health insurance premium is approximately $4,800 per month. He has saved $52,000 over 4 years of disciplined effort. He gets pre-approved for a $410,000 mortgage. He finds a house listed at $430,000. A 3-bedroom in a suburb he likes. Good schools. Reasonable commute. He puts 10% down, $43,000, and finances $387,000 at 6.5% for 30 years. His mortgage payment is $2,450. Property taxes in his county run $540 per month. Homeowner's insurance is $210. PMI, because he put down less than 20%, adds $225. He sets aside nothing for maintenance because he does not fully believe the 1% rule applies to a house that is only 8 years old. His total monthly housing cost is $3,425. That is 71% of his $4,800 monthly take-home. He has $1,375 remaining for groceries, utilities, transportation, subscriptions, clothing, entertainment, and everything else his life requires. On the day he signs the closing documents, Jason does not calculate it this way. He is focused on the mortgage payment, $2,450. That is what he told his friends. That is the number that felt manageable. The real number, $3,425, is the number that is about to run his life. The first month Jason owns the house is genuinely one of the best months of his adult life. He gets the keys on a Thursday afternoon. He walks through empty rooms, imagining furniture. He calls his parents, and they are proud of him. He posts a photo of the front door with a caption that gets 43 likes. His monthly payment clears without drama. He is a homeowner. He did it. The financial tightness of the first month does not register as tightness because he is operating on the adrenaline of a major life milestone. He eats out less without consciously deciding to. He declines a weekend trip because he is moving in and setting up, and that feels like a normal reason. The $1,375 remaining after housing does not feel dangerously thin in month one because Jason has $9,000 left in savings after the down payment and closing costs, a number that feels like a buffer, even though it is less than 3 months of his total housing cost. Month one is fine. Month one always is by month 3. Something has shifted quietly. Jason has noticed, without fully naming it, that he is managing his spending in a way he did not used to have to manage it. He is checking his account before agreeing to things. He declined a friend's birthday dinner, the second social event he has missed in 2 months, and the reason he gave was vague. He bought furniture for the living room, modest pieces, but he put $600 of it on his credit card because the month was tighter than expected, and he told himself he would pay it off next month. He did not pay it off next month. The balance is still there in month 3, now carrying interest. His savings account, the $9,000 buffer he had at closing, is at $6,400. He has spent $2,600 from savings in 3 months, covering gaps that his monthly income did not fill. This is the first signal. Not a crisis, not a warning alarm, just a quiet, persistent gap between what comes in and what goes out that is slowly drawing down a buffer that was already thin. Jason does not name this signal in month 3. He tells himself he just had some startup costs from the move in month 6. Jason's car needs new brakes and a tire rotation. The repair bill is $840. This is not a catastrophic expense by any reasonable standard. It is a normal, predictable, inevitable cost of car ownership that arrives at an interval that should be easy to absorb for someone with a stable job and a healthy financial cushion. For Jason, it is not easy to absorb. His savings account is at $3,200. Paying $840 from savings does not feel fine. It feels alarming. He puts $300 of it on his credit card. His credit card balance is now $960, carrying interest at 22%. He makes the minimum payment. This is the month Jason starts feeling something he cannot quite name. Not panic, not regret exactly. Something closer to the awareness that his financial life has less room in it than he thought it did. He is working the same job at the same salary, doing the same things he was doing before he bought the house. But every financial decision has acquired a weight it did not used to have. He thinks about the house more than he enjoys it. He is calculating more than he is living. This is month 6 by month 9. Jason has done something he resisted doing for 8 months. He sat down and actually wrote out his monthly numbers. All of them. What comes in and where it goes. And the result, staring at him from a legal pad on the kitchen table of the house he worked 4 years to afford, is that his budget does not balance, not by a little, by approximately $400 every single month. He is spending $400 more per month than he is bringing home. Not because he is being reckless, not because he is going on vacations or buying things he does not need. Simply because the real cost of owning this house, the mortgage plus taxes, plus insurance, plus PMI, plus the utilities that are higher than his apartment, plus the minimum payments on the credit card balance that has now grown to $1,400, exceeds his take-home pay when combined with the basic costs of his life. 47% of those who identify as house poor admit to occasionally missing other payments to meet costs associated with their home. Jason has not missed any payments yet, but he understands for the first time in month 9 exactly how someone ends up there. He has stopped contributing anything beyond his automatic 401k contribution. His Roth IRA, which he was funding manually with $200 a month before the house, has received nothing in 9 months. He tells himself it is temporary. Here is something that happens in year 1 that nobody talks about in housing conversations, and that is more consequential than any single expense. Jason's relationship with his job changes. Before the house, Jason was a reasonably confident employee. He had a financial cushion. He asked for things. He pushed back occasionally on assignments he found unreasonable. He was considering a lateral move to a competitor that would have required a 2-week gap between positions, but offered a meaningfully better long-term career trajectory. He did not make that move. He cannot afford a 2-week gap in income. He cannot afford the risk of a new job not working out during a probationary period. He cannot afford any disruption to the paycheck that is currently the only thing standing between him and a genuinely serious financial crisis. 99% of those who identify as house poor face some type of financial challenge every month. Jason is not technically house poor by the clinical definition, but the house has made him financially fragile in a way that is now reshaping how he operates at work. He says yes to things he would have said no to. He does not raise the issue with his manager that has been bothering him for 3 months. He stays in a role that is not growing him because leaving feels too dangerous. The house is not just consuming his money, it is consuming his professional leverage. This is the cost that never appears in any mortgage affordability calculation. In month 14, the water heater fails. It is 8 years old. This was statistically predictable. The typical water heater lasts 8 to 12 years. Jason's house is 8 years old. Any competent financial advisor would have told him that several of the home's major systems were approaching replacement age, and that his maintenance reserve should reflect that reality. Nobody told Jason, or, if they did, he did not hear it. The way he would hear it now, standing in his basement, looking at a water heater that is leaking from the bottom and a repair quote of $1,300 for replacement. Jason's savings account has $430 in it. His credit card has a balance of $2,100. He puts the water heater on the credit card. His total credit card debt is now $3,400 at 22% interest. His minimum payment is $89 per month. He is paying $89 every single month to service. Debt that exists entirely because he bought a house he could barely afford, and a predictable maintenance expense arrived with no financial cushion to absorb it. This is month 14. This is the moment the trap fully closes. Let me pause Jason's story for a moment because I want to show you what the research says about what happens to people in his specific position, because it is not random and it is not individual. It follows a pattern that researchers have documented with enough specificity to be genuinely disturbing. Buffer depletion indicators, including savings rate, debt service ratio, and retirement account, hardship withdrawals have historically led debt stress indicators, including mortgage and consumer delinquency, by 2+ years. When households exhaust their financial cushions, payment failures follow, first in unsecured debt such as credit cards, then in secured debt such as auto loans, and eventually in mortgages. Jason is currently in the buffer depletion phase. His savings are gone. His credit card debt is growing. He has stopped voluntary retirement contributions. The research says the next phase, if nothing changes, is payment stress on his credit card, then potentially his car loan, and then, in the scenarios that end badly, his mortgage. He is not there yet. He is not in foreclosure. He is not missing payments, but he is on the documented trajectory that leads there when an additional shock arrives before the buffer has time to rebuild. And the shocks keep coming, because life does not pause to let you recover. In month 18, something happens that should be good news. Jason gets a job offer, a genuinely better role at a competing company, $15,000 salary increase, better career trajectory, more interesting work, the kind of opportunity he would have taken immediately 2 years ago. He runs the numbers. The new job requires him to pass a background and credit check that includes a soft pull on his financial history. His credit utilization, the percentage of available credit he is currently using, is at 68% because of the credit card debt. His score has dropped from 740 to 690. This does not disqualify him from the role, but it is visible. More importantly, the new job comes with a 90-day probationary period during which he could be let go without severance. 90 days with no financial cushion to absorb that outcome is a risk that 2 years ago he could have absorbed. Now he cannot. He takes 48 hours to think about it and then declines. He stays in the job that is not growing him, in the house that is consuming him, because the house has removed the financial margin that professional risk requires. He tells his contact at the other company that the timing is not right. The timing will not be right for as long as the house owns him rather than the other way around. By the end of year 2, something has happened to Jason that is harder to quantify than any of the numbers I have given you, but more consequential than most of them. He has adapted. Human beings are extraordinarily good at adapting to circumstances, and this is usually a strength. In Jason's case, it is working against him. He has adjusted his life to fit inside the financial constraints the house created. He does not go to the dentist because his insurance does not fully cover it, and he cannot absorb the out-of-pocket cost. He drives his car on tires that are past their recommended replacement mileage because new tires are $350 he does not have. He has not taken a vacation. He has not contributed to his Roth IRA in 18 months. He has stopped thinking about the career move because the mental energy of managing a constrained financial life consumes so much of his bandwidth that longer-term planning feels like a luxury he cannot currently afford. Only 30% of those who identify as house poor felt able to shoulder more household expenses. Jason is in the 70%. And the most insidious part of year 2 is that none of this feels like a crisis anymore. It feels like his life. The adaptation has normalized the trap. Let me be direct about what a different version of this story looks like, because I do not want this timeline to be pure horror without practical application. The version of Jason who buys a house he can comfortably afford rather than barely afford looks like this. Same income, same desire for home ownership, different price point. If Jason had bought a $320,000 home instead of $430,000, putting 10% down on a $320,000 purchase, his real monthly housing cost would have been approximately $2,680 instead of $3,425. His remaining monthly take-home after housing would have been approximately $2,120 instead of $1,375. That additional $745 per month is the difference between financial fragility and financial resilience. It is the difference between a water heater replacement being an inconvenience and being a crisis. It is the difference between being able to take the job offer in month 18 and having to decline it. It is the difference between a house that serves your life and a house that owns it. The $320,000 house is less impressive. It has fewer square feet. It is probably in a slightly less desirable location. It is also a house Jason can actually afford. And the financial life he builds inside that house over the next decade looks nothing like the timeline I just walked you through. Here is the specific calculation I want you to do before signing any purchase agreement. Take your real total monthly housing cost, the number that includes mortgage, property taxes, insurance, PMI if applicable, and a genuine maintenance reserve of 1% of the purchase price divided by 12. Divide that number by your actual monthly take-home pay after taxes, retirement contributions, and health insurance premiums. If the result is above 30%, you are in Jason's territory. You are buying a house you can barely afford. And the timeline I just walked you through is not a worst-case scenario. It is the documented, statistically predictable, repeatedly observed pattern that follows that decision with enough consistency that it qualifies as a rule rather than a risk. As of the most recent American Community Survey data, about 20.3 million homeowner households are cost-burdened, spending more than 30% of their income on housing. 20 million households are currently living inside some version of Jason's timeline. Not because they were irresponsible, because they used the wrong number to decide what they could afford, and nobody corrected them before they signed. A house you can genuinely afford does something specific and underappreciated. It stays in the background. You live in it. You enjoy it. You do not think about it constantly the way Jason thinks about his. You are not calculating whether you can afford the dentist because of it. You are not declining job offers because of it. You are not watching your savings disappear into a gap between what you earn and what it costs to own it. A house you can barely afford moves to the foreground of your entire financial life and stays there. Every financial decision you make for the next decade gets filtered through the question of whether you can still make the mortgage payment. The house becomes the organizing fact of your financial existence rather than one component of a healthy financial life. Jason is not a cautionary tale about greed or recklessness. He is a cautionary tale about the gap between the number the bank uses to define affordability and the number your actual life requires to remain financially functional, flexible, and free. That gap is where the timeline I just showed you lives. And the only way to avoid it is to calculate your real number, not the bank's number, before you sign. Because once you are inside the timeline, the exit costs more than the entrance did.